Silver just had one of its worst weeks in months. And if you've been holding through it, the explanation you've probably heard online is incomplete, maybe even wrong in a few places. So let's actually walk through what happened, what it means, and more importantly, what has to happen next. Before we get into it, I want to ask you something. When a market falls this hard, this fast, do you think the real explanation usually fits inside a single headline? Or is it almost always more complicated than that? Hold on to that question because by the end of this video, I think you'll have a different answer than you did when you clicked on it. Let's start with the facts, because they're genuinely dramatic without any exaggeration needed. As of Friday, June 19, 2026, silver closed below $65 an ounce, its lowest level in about a week, and on track for a weekly loss somewhere around 4.5% to 5%. Over the past month alone, the metal is down roughly 14%. Gold didn't fare much better. It slipped below its 200-day moving average for the first time since October of 2023, landing in the low 4,100s. Both metals are sitting well below where they traded earlier this year, when silver touched an all-time high above $121 in late January, and gold was flirting with 5,500. So what actually happened? It started on Wednesday. Early that morning, reports surfaced that a peace framework between the United States and Iran was close to finalized. Silver, which trades heavily on geopolitical risk premium, jumped on the news, climbing back into the high 60s and briefly brushing against $70. For a few hours, it looked exactly like the relief rally beaten down silver holders had been waiting for since the correction began months earlier. Then, 2 o'clock Eastern arrived. That's when the Federal Reserve, under brand new chair Kevin Warsh, in his very first meeting at the helm, released its policy decision. And what came out of that meeting wasn't really about the rate itself. The Fed held steady at 3.5% to 3.75%, exactly as almost everyone expected. Nobody serious was trading the rate decision. What mattered was everything happening around it. 9 of the Fed's 19 policymakers indicated they now see at least one rate hike before year-end. That's a real shift from where the committee stood back in March, when the conversation still centered on the possibility of a cut. The Fed's preferred inflation gauge, core PCE, got revised up to 3.6% for year-end, a sharp jump from 2.7% just 1 quarter earlier. And then there was the genuinely unusual part. Warsh didn't submit his own projection to the dot plot at all. He simply opted out of it. The policy statement itself got cut from over 300 words down to roughly 130, stripped of almost all the forward-looking language traders have relied on for years. On top of that, he announced 5 separate task forces to review everything from how the Fed communicates to how it manages its balance sheet to the inflation framework itself. Markets reacted instantly. The dollar index surged to its highest level in roughly a year, on track for one of its best single days in months. 2-year Treasury yields jumped sharply, touching territory not seen in well over a year. And silver, sitting near $70 just hours earlier, fell hard, eventually dropping below 65 by Friday's close. Now, here's where most of the coverage you've probably already seen tends to stop. They'll tell you silver fell because the Fed turned hawkish, and then move on. That part is true, but it's not actually the interesting part of the story. The interesting part is what happened the very next day, because what should have been good news for silver ended up making things worse instead of better, and almost nobody is connecting those two events properly. For months, a large part of the bull case for silver rested on a simple idea. Once the Iran conflict resolved, oil would fall, inflation would cool, and the Fed would finally have room to cut. That logic isn't wrong. It's just slower than people assumed it would be. On Wednesday night, the interim agreement between Washington and Tehran was formally signed, a 14-point memorandum covering a 60-day ceasefire window, sanctions relief on Iranian oil, and the reopening of the Strait of Hormuz, the waterway through which roughly a fifth of the world's oil normally passes. Crude prices fell on the news. Shipping conditions through the strait started showing early signs of normalizing. On paper, this is exactly the disinflationary trigger silver bulls had been waiting on. But here's the problem. Shipping lanes don't reopen instantly. Tanker schedules, insurance arrangements, and supply chains take months to fully normalize, not days. Meanwhile, the Fed's hawkish shift landed in the exact same 24-hour window, and it repriced instantly, within minutes of the statement hitting the wire. One of these forces moves on a calendar measured in months. The other moves on a calendar measured in milliseconds. When they collide, the fast one wins the week, even if the slow one ends up being the more important force over the long run. Then, just to make things messier, Friday brought another complication. Switzerland's foreign ministry announced that planned follow-up technical talks between the US and Iran, scheduled to take place near Lucerne, would not go ahead as expected. Vice President J.D. Vance, who'd been set to attend, scrapped the trip, with the White House citing unresolved logistical issues. None of this means the broader deal is collapsing. Israel and Hezbollah moved into a separate ceasefire that same day, but it's a reminder that an interim memorandum signed under pressure isn't the same thing as a finished, durable peace. The market had been pricing a clean, linear path toward de-escalation. What it actually got was a real agreement, paired with a messy, uncertain process for finishing the job. That mismatch between the headline and the mechanics underneath it is a big part of why silver couldn't hold on to Thursday's bounce. But the Fed story isn't finished either, because the part that's genuinely unusual here, the part most retail commentary glossed right over, isn't the rate decision at all. It's what Warsh did to the way the Fed talks to markets going forward, and I think it actually matters more than this week's price action. For more than a decade, the Fed's quarterly dot plot has functioned as the market's compass. Traders didn't just react to what the Fed had already done, they positioned around what those dots implied was coming next. That compass just got partially switched off. When the chair himself declines to submit a projection, and the policy statement gets cut down to its barest bones, markets lose a tool they've leaned on for years to anticipate the next move. What you get instead is a market trading meeting to meeting, data point to data point, without the cushion of an official forecast underneath it. That's a structurally more volatile environment, and it tends to produce exactly what we saw this week, an overreaction to a single data release, because there's no pre-existing expectations softening the surprise. But there's a flip side worth sitting with because it cuts the other way too. If this Fed really intends to govern off incoming data rather than guided expectations, then every inflation print between now and the next meeting becomes a high-stakes event in both directions. A soft inflation report in a no-guidance world could move silver just as sharply to the upside as this week's report moved it down, precisely because there's no anchor cushioning the surprise either way. That's not comfort for the week you've just lived through. But it is context for why the next couple of data releases matter more than almost anything a Fed official says out loud between now and then. If you're new here, this channel exists for exactly this kind of breakdown, taking a chaotic week of headlines and actually walking through the mechanism underneath them, rather than just the panic sitting on top. If that's useful to you, subscribing means you won't miss the next one, especially with how fast this Iran situation and the Fed's new communication approach are both still evolving. All right, let's keep going because there's a part of this story that's been almost completely buried under this week's red candles. While silver was getting hammered, something else happened in the background that received almost no coverage relative to how significant it actually is. The World Gold Council just published its latest survey of central banks, drawing responses from 76 institutions, the highest participation in the 9 years the survey has run. A record 45% of those central banks said they personally expect to add to their own gold reserves over the next 12 months. Not an elevated number, the highest the survey has ever recorded, and almost 90% believe global central bank reserves overall will keep growing regardless. Central banks aren't day traders, they don't get margin called, they aren't reacting to a single Wednesday press conference. Look at the first quarter of this year. Officially reported purchases through the IMF came in at a modest 16 tons, but the World Gold Council's own modeling, which accounts for purchases that never get formally reported through official channels, estimates the real figure was closer to 244 tons, with a meaningful chunk of that appearing to be untracked buying. Some of it almost certainly traces back to China, whose gold imports jumped sharply in the first quarter, and whose central bank has now added to its official reserves for 18 consecutive months in a row, through every phase of this Iran conflict, every ceasefire, every reopening and reclosure of Hormuz, without missing a single month along the way. This is the distinction that actually separates a trader's view of this market from a long-term holder's view. The hawkish Fed shock is a real yield story. It raises the near-term cost of holding something that pays no interest, and that's genuinely bearish for both metals today, this week. But the central bank buying is a different story entirely, a bet on currency debasement, on the long-term trajectory of sovereign debt, on de-dollarization that has almost nothing to do with whether one Fed chair held rates steady in June. Those two forces aren't actually arguing about the same question. This week, the fast-moving one won. That doesn't mean the slow-moving one lost. It just means it was never fighting on this particular timeline to begin with. And the central bank story isn't even the only structural force sitting quietly underneath this correction. The Silver Institute's most recent World Silver Survey, published earlier this year alongside the research firm Metals Focus, projects that 2026 will mark the sixth consecutive year the global silver market runs a supply deficit, an estimated shortfall of roughly 46 million ounces, wider than last year's gap. Since 2021, the market has drawn down somewhere around 762 million ounces from above-ground stockpiles just to bridge that gap, a number with essentially no precedent in the modern history of this market. Here's what makes this year's version of the deficit interesting. Solar manufacturers, who became the single largest source of industrial silver demand over the past several years, have cut the amount of silver used per panel by close to a fifth, simply because the price got expensive enough to force that kind of thrifting. That's normal economic behavior, not evidence the long-term industrial case is breaking down. But even with that pullback, the deficit is still widening rather than narrowing, because other industrial categories are picking up the slack. Battery electric vehicles use meaningfully more silver per unit than the combustion vehicles they're replacing, somewhere in the range of 2/3 to nearly 80% more, spread across battery management systems and power electronics. Data centers and AI infrastructure are adding their own steady pull on the metal too. None of that changed on Wednesday. The deficit doesn't read FOMC statements. It just sits there, quietly accumulating, regardless of what the dot plot says this quarter. There's a related number worth sitting with for a moment, the gold-to-silver ratio, which simply measures how many ounces of silver it takes to buy 1 ounce of gold. Back in May, that ratio sat closer to 55. Today, it's drifted up into the low to mid-60s, which tells you silver has actually cheapened relative to gold during this stretch, even though both metals fell together. Historically, periods where that ratio sits in the 60s have sometimes preceded stretches where silver outperforms gold on the way back up, since silver tends to lag on the way down and then overshoot once monetary conditions turn. That's not a prediction, and ratios like this can sit at elevated levels for a long stretch without resolving quickly. But it's one more data point suggesting silver's recent underperformance against gold may be more about leverage and liquidity than about any change in its underlying industrial story. It's also worth pausing on what kind of inflation problem the Fed is actually responding to here, because that detail shapes how long this could realistically run. Much of the inflation pressure behind this week's hawkish turn traces back to energy costs tied directly to the Hormuz disruption, not to a deeper, structural wage price spiral working through the broader economy. That distinction matters. Inflation driven by a closed shipping lane tends to carry a built-in resolution mechanism. It eases as the lane reopens and shipping normalizes. Inflation driven by years of deeply embedded structural pressures doesn't behave that way, and historically has required a much longer, more painful adjustment period to fully unwind. None of this guarantees a quick turnaround, but it does suggest the current hawkish posture may be responding to a problem with a visible expiration date, rather than an open-ended one, which is a meaningfully different setup than past hawkish shocks that hit precious metals hardest. Now, I want to address something directly, because if you've seen headlines about leveraged silver products getting torched this week, there's a piece of this you need to understand before drawing any conclusions from it. Triple leveraged daily silver products don't just amplify silver's move by 3 times on any given day. They reset that exposure every single day, which means in a choppy, volatile market, exactly the kind a no-guidance Fed tends to produce, the compounding works against holders even when the underlying metal eventually ends up close to where it started. Silver's actual round trip this week, from the high 60s down into the low 60s and back to settling near the mid-60s, is a real and painful move. But it's nowhere near as violent as headlines about leveraged products losing 15% in a week might suggest on their own. A meaningful chunk of that leveraged carnage wasn't fresh investors deciding the silver story just got worse. It was mechanical, forced de-risking inside instruments that simply aren't built to survive this kind of volatility, regardless of which direction the metal eventually moves. This distinction matters quite a bit if you're holding physical metal or unleveraged positions rather than daily reset products. The price correction you're sitting through is real. It is not, however, the same magnitude of damage that the most dramatic leveraged product headlines this week might have led you to believe. There's one more wrinkle to this week worth understanding, because it tells you something about whose conviction this sell-off actually reflects. American markets were closed Thursday for the Juneteenth holiday, which meant a chunk of the price action moving through that period wasn't being driven by U.S. investors digesting Wednesday's Fed shock in real time. It was largely being set by trading desks across London and Asia, where actual physical buyers, jewelry fabricators, industrial users, and investors purchasing real coins and bars rather than paper futures exert far more direct influence on price. Silver's price discovery has been steadily shifting eastward for years now, and this week offered a clean look at what that shift actually does. The early read suggests precious metals continued drifting lower through that period, but without the same violent, leverage-driven character that defined Wednesday's American session. A sell-off driven primarily by leveraged paper positions unwinding in U.S. futures markets behaves differently than one with genuine conviction behind it from buyers who actually need the physical metal for industrial use. If Asian physical demand keeps quietly absorbing supply at these lower prices, even while American paper markets stay in full hawkish repricing mode, that kind of divergence has historically tended to show up closer to a floor than to the middle of an ongoing collapse, though of course nothing here is guaranteed. So where does that actually leave you if you're trying to figure out when this turns? Here's the honest framework, not a specific price target, but the actual sequence of things worth watching over the coming weeks. First, watch the dollar over the next several weeks rather than the next several days. Dollar strength built on a single hawkish surprise, inside a market that just lost its forward guidance anchor, has historically tended to be more reflexive, capable of overshooting on the initial shock and then partially fading as the underlying data either confirms or contradicts the Fed's new posture. Second, watch the actual inflation prints rather than how the Fed chooses to interpret them, since this is now explicitly a data-dependent committee. If headline inflation, which has been running elevated largely because of war-driven energy costs, starts meaningfully cooling as the strait genuinely reopens over the coming months, that erodes the justification 9 committee members currently have for favoring a hike, with or without forward guidance attached to it. Third, keep a close eye on core PCE specifically, since that's the gauge this Fed has said it weighs most heavily. And fourth, watch physical premium signals out of Shanghai alongside COMEX delivery data. If paper prices keep falling, while physical buyers keep quietly absorbing metal at a widening discount to what a structural deficit implies fair value should be, that gap is one of the cleanest signals that a sell-off has become a paper market phenomenon disconnected from underlying physical reality. Gaps like that have a history of closing in sharp, compressed moves rather than gradual ones. In terms of timing, the Fed's next 2 scheduled meetings land on July 28th and 29th, and then September 15th and 16th, with the September meeting bringing another full round of economic projections. Markets are already pricing in something close to a 70% probability of a hike by that September meeting, which tells you how seriously this week's shift is currently being taken. Whether that probability holds, climbs, or fades between now and then will likely depend far more on the next couple of inflation reports than on anything said in any press conference. It's also worth noting that even after this week's pullback, not a single major bank has abandoned its bullish year-end target for either metal, though some have trimmed them. Goldman Sachs, for instance, lowered its year-end gold call from $5,400 down to $4,900, while still leaving that target meaningfully above where gold sits today. That's not capitulation, that's recalibration, a sign institutions are adjusting the pace of their expectations without abandoning the underlying thesis entirely. So here's where I think this actually leaves you. The sell-off you've lived through this week is real, and there's a reasonable chance it isn't completely finished, because dollar strength built on a genuine policy shock typically takes weeks rather than days to fully work through a market. But the forces that didn't show up in this week's headlines, a record share of central banks committed to buying more gold, a silver deficit that kept widening even as the price fell, and a shipping lane that is, slowly, actually reopening. None of those forces argued with this week's price action. They simply operate on a completely different clock than a Wednesday afternoon press conference does. The investors who tend to get hurt worst in moments like this are the ones who mistake this week's dominant force for the only force that exists. So here's the question I'd genuinely like you to sit with, and I'd love to hear your answer in the comments. When a market is being pulled in 2 directions at once, a near-term monetary headwind and a long-term structural tailwind, how do you personally decide which signal deserves more weight in your own decision-making? There's no single correct answer to that question, and working through it for yourself is more valuable than any single price target I could hand you. Drop your take below. I read through these and they genuinely shape what I dig into next. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.